Rebel Capitalists, hope you're well. We got the CPI print out this morning. I wanted to go over that with everyone. I just looked at it, had a few thoughts, and I pulled up an article on CNBC, so we'll kind of go over that together. I got my Miami hat on, my brand new Miami Formula One hat. Okay, I think Josh is on a flight down to Mexico, which is where I should be. So I'll go ahead and run this myself. So we got the screen share on, and let's go over to that. Okay, cool. So headline: inflation rose 0.1% in August, even with sharp drop in gas prices. So the headline number, if you recall, was 8.5%. We went down to 8.3%, but everyone in the mainstream media is saying and pointing out how this is far higher than expectations. Expectations were for the headline CPI number to go down, I believe, sub 8%, something like that. So this, and they figured that the month on month would go down, and it actually went up slightly. And I think the big reason the stock market is down, which, like you read in the title, down 800 points as a result of the CPI number surprising on the upside, which would imply that the Fed is going to raise rates higher than expected and maybe accelerate it at a faster pace. I was reading on Zero Hedge that the probabilities the market is giving to a 100 basis point rate hike the next time the Fed meets, just shot up. I don't know what the exact percentages were or probabilities, but it shot up significantly. So as expectations for interest rates go higher and surprise on the upside, the stock market takes a hit. So let's go into this CNBC article and find out more about the details and how we got to this 8.3 number, how we got to this 0.1 number for the month, and then maybe more importantly, the core CPI, X food and energy, because that's really what the Fed looks at when determining what they're going to do, or at least that's what they say. I mean, who knows what they do in reality, but at least that's what they say. Key top talking points: the consumer price index increased 0.1% in August, excluding food and energy. The inflation gauge rose 0.6%. So you say, that's weird because I'm paying a lot more when I go to the grocery store. You are correct. So food went up, but we had a significant decline in gas prices, and that kind of offset the rise in everything else. And so what the market was expecting was a significant drop in gas prices, but then also kind of a flat line, probably for food, shelter, medical services, and they actually increased. So if you would have excluded gas prices, headline probably would have been higher than it was last month, year over year. So next talking point, just reiterating what we were just saying, costs were driven by increases in food, shelter, medical care services, offsetting a sharp decline in gasoline prices. One of the things that Tracy Shukart pointed out on Twitter, Shy Girl, she's fantastic, is these sharp decline in gas prices come at the cost of further depleting the SPR. Sorry about that. It took me a second to think of it. The Strategic Petroleum Reserve. So this is something that we should not be tapping into, and we are. And you could argue that gas prices would not have gone down as much if we would not attempt to flood the market with the reserves, the stockpile reserves we have of petroleum that is really there in case of some sort of catastrophic event like a war or some sort of natural disaster that would prevent us from attaining the petroleum we need or having access to the petroleum we need to function daily as a society. So to prevent the collapse of society, you've got something in storage. So that's what we're tapping into, basically, as just using it as a political tool to try to bring down gas prices in front of midterm elections. I mean, ethically, it's disgusting, but obviously we shouldn't expect more from the politicians, central planners, and authoritarians. Final talking point, real average hourly earnings adjusted for inflation actually rose 0.2% for the month. However, they remained down 2.8% from a year ago. All right. So like I said, I've not highlighted this one and just go through it on the fly and give you guys my thoughts. Let's see, CPI, core CPI, when you exclude, they always say the volatile food and energy. Why not just food and energy? I don't know why they always have to preface that with volatile. Okay, I get it. So the CPI, core CPI, excluding the volatile food and energy, rose 0.6% from July and 6.3 year over year. Economists had been expecting headline inflation to fall 0.1, and just a reminder, it went up 0.1, and core to increase at 0.3. There's a delta there, 0.3%, so it went up by 0.6. The respective year-over-year forecasts were for 8 and 6. Okay, and we got 8.3 and 6.3. Energy prices fell 5% for the month, led by 10.6 decline in gas. So you can imagine if, let's just assume for a moment, and I don't know if these numbers are correct, they're probably wrong, but just to understand the concept. If we would not have further depleted the SPR, then maybe that number would have been 0. And if that number would have been 0, gas, then again, the headline CPI probably would have gone up, not down, from that 8.5% that we had last month. Food index increased 0.8 in August alone, and shelter, which makes up about 1/3 of CPI, jumped 0.7 and are up 6.2 for the year. Yeah, so just as a reminder, the shelter is not home prices. It's not even rent, really. They call it owner's equivalent rent, which is just basically a concocted number that they pull out of thin air. So I think it's very difficult to determine or predict what owner's equivalent rent is going to be, because it really has nothing to do with home prices. And in all honesty, it has nothing to do with rents. So you say, well, how do they get the number? They just call people and say, hey, you've got a house. So if you're going to rent that house, what do you think you'd rent it for? You'd think they'd actually go to market data to see what rents are actually doing, instead of just asking people's opinion as to what they would rent their house for and assuming that's just superior to empirical or just data that has been received by price action in the actual rental market itself. But moving on, medical care services, big gain, rising 0.8% on month and up 5.6%. New vehicle prices climbed. That doesn't surprise me. Market slumped after the news, down 3. Okay, so this is old because it was down on the news 350 points. Now, as you can see by this real red breaking thing, it's down 800 points. So here's Mike Lewingart from Morgan Stanley. Today's CPI reading is a stark reminder of the long road we have ahead. Until inflation is back down to earth. Wishful expectations that are on a downward trajectory, and the Fed will lay off the gas. Okay, so here, this is what I don't understand. I don't understand this narrative. And the narrative is inflation coming down, and let's just say it came down to like 6 or something. So if inflation is coming down, then the Fed can not raise rates, they can pause, and or even lower rates. So as an example, let's just say that CPI went from 8.5 and this month it was down to 2%, which is kind of their target. Then the market is like, oh, well, that would be great news, because then the Fed could take interest rates back down to zero. And I don't understand how that's great news. Because why, if the economy was truly healthy, well, let's remember here, interest rates aren't at 8%, for heaven's sakes. Interest rates are deeply negative in real terms. So to think that our economy is so sick and fundamentally unsound that we would need to take interest rates down to 0%, or that we can't take interest rates back up to a historic norm, let alone, well, I guess if CPI went down to 2%, they'd be positive in real terms. So that's good. But to think that we that the economy cannot stand quote unquote normal interest rates, when you look at it in terms of historical standards, I don't see how that's a good thing. Oh, yay, the Fed can take rates back down to zero. That's just another way of saying, oh, yay, the economy is so fundamentally unsound that it cannot withstand normal interest rates. Because that's really one and the same. So I don't know why these talking heads think that is so wildly bullish for the U.S. economy. Now, what would be wildly bullish for the U.S. economy is if the Fed could raise rates to 6% and the economy just shrug it off and still continue to grow in real terms, and for the society at large to produce more goods and services. That's what would be wildly bullish. Simply just injecting more heroin into the drug addict, I don't see how that's wildly bullish for the drug addict long term. But let's get back to the article here. U.S. Treasuries higher. 2-year note, which is most closely tied to Fed interest rates, surged 0.13%, 13 basis points, up to 3.7. The 10-year was up a little bit, not that much, still wildly inverted. And really, I think my main takeaway from this CPI print is, if the Fed does continue to raise rates or raises rates more aggressively due to the core CPI exceeding their expectations, what does that do to the dollar? Right? Let's not forget the dollar right now, 1.9, almost 110, 1.9, almost 110 here. So as you guys know from watching my videos and listening to Brent and Jeff, this is no bueno for the global economy. This is extremely, extremely bad. So let's just assume for a moment the Fed, because inflation continues to run hot, the Fed takes rates up to 4%. Maybe they normalize. Who knows? Maybe inflation gets that bad. Well, we can see inflation really is not, meaning the domestic inflation in the United States is really not impacting the dollar at all against other currencies, or we wouldn't see the Dixie at 110. So even if inflation continues to run hot domestically in the United States, I don't think that impacts the dollar, but against other foreign currencies. But we know that interest rate differentials do. So if the Fed continues to hike at a faster pace relative to other central banks, one would assume, and no certainties, only probabilities, but there's a high probability that the dollar goes from 110, let's call 120. What does that do to global economies? And then what are the systemic risks to the United States economy itself? So when we understand how sick the economy is, and oh, by the way, if you want to look at another chart that I pulled up, this is the delta between the 2s and the 10s. And let's look at the 1-year chart, because I think that's most interesting. Remember back in April when the curve inverted initially, April 22. Obviously, I was talking about this, as you guys remember, but most people on Twitter in the talking heads and CNBC were saying, oh, this is just nothing. This is an anomaly. Nothing to see here. Even though every single time we get an inversion going back to 1950, we've got a recession within 18 months. Don't worry about that. It's different this time because of blah, 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 blah. And, the rationale they always gave was, oh, look, it was only inverted for, 3 or 4 days here? It was only inverted for 3 or 4 days. So that's just noise. Remember, that was the pushback. That was the argument. Okay, well, let's fast forward to what happened or what has happened since July. Oh, yeah, that would be the inversion of the yield curve. So now it wasn't 4 days. Now it's been 3 months, let's just say, right? 3 months has been July, August, September, 2 months. 2 months. So 2 months straight, we've had the inversion of the yield curve. Obviously, now they can't make that argument that, oh, it's just noise. So this would indicate a global economy that was incredibly sick. I mean, kind of standing on its last leg before just a subtle breeze comes by and tips it over. So you combine this with, and maybe this curve is so inverted because of the dollar, or maybe the dollar is a derivative of the curve being inverted, which is a derivative of the health or lack thereof, not just of the US economy, but the global economy itself. So it's kind of like a chicken or egg type thing, but we all know that when you get this chart along with the dollar skyrocketing, that is bad news. That is not a sign of economic activity improving. So then you think through, okay, we get a high CPI print. Well, that means that potentially the Fed is going to raise even more, which would make this DXY go even higher. It's even higher than when I clicked on it we just saw it. And then that would lead me to believe the curve is going to invert even more, or at least stay inverted even longer than we would expect it to, looking at past inversions. So then the next place my mind goes is black swan, because we look at what the Eurodollar futures curve and all these things are telling us, that 2023, most likely, Fed starts reversing course. And if they were to reverse course, I don't think it would be just because inflation was coming down. I think it would be inflation is coming down because we have some sort of, I don't want to use the word catastrophe, but we have some sort of crisis, I think would be a better word. So, what would this be? A black swan, by very definition, nobody can really predict it. That would include me. It's not something that would be obvious. So, like monkeypox as an example, that's very low probability that would be, because that's on people's radar, I should say. And a black swan, by definition, is usually on nobody's radar. And so, what is something that's on nobody's radar? Well, I think the dollar. As far as the dollar creating the next black swan. So I know this might be on Brent Johnson's radar. I've talked about it a couple times, but for the most part, especially in the mainstream media, I mean, nobody is talking about this at all. I think would kind of laugh at the idea. Not to say that we don't continue to have consumer price inflation here. You guys know well from watching my videos that there's two different dollars we're talking about. And just because the dollar in the United States is going down, the domestic dollar, we'll call it, against goods and services, doesn't mean that the dollar internationally can't go up against other fiat like the yen and the euro. So you guys know that from watching my videos. For most people, for the normies out there, you want to call them that, that's a very difficult concept for them to get their head around. And very few people really understand it. But you guys know that we can go to 110, 120, 130 on the DXY, while inflation is still in the United States above, pick a number, 8%, 9%, 7%. So if that happens, then what's the next shoe to drop as far as the global economy? And then, does that bleed into credit markets? And then what is the systemic risk, the contagion risk that could bleed into the United States and create that type of black swan that would prompt the Fed to go from wherever they are at the time, let's say 3.5, right back down to zero. Again, one of the mistakes that I think that these talking heads make is assuming, well, okay, what we're going to have is gradual disinflation, and the Fed is going to pause for 6 months, and then if they see the need to, then they're going to go ahead and drop rates a little bit and tinker around with their models and the dot plot and yada, 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 yada. It'll be like watching paint dry. Yeah, I don't think that's how it plays out. It could, but when I see the Eurodollar future curve predicting the Fed is going to lower rates, let's just say in 2023, I don't see that as a result of the Fed just winning the fight with inflation and just gradually bringing the CPI from 8.3 down to, let's call it 3% or 2% or something like that. I don't see it that way. I see the CPI falling not as a result of what the Fed is doing, but a result of a crisis. The cerveza sickness would be a great example. The GFC would be a great example. So the GFC, you could argue that we did have deflation. In fact, the CPI went negative, but that wasn't because of the Fed's just wanting to gradually move the thermostat to a lower temperature. That was because the whole market collapsed and we had Armageddon. That's what brought down inflation very, very quick. Same thing with the cerveza sickness. Now, inflation wasn't that high as measured by the CPI, but the cerveza sickness brought it down pronto. And I think that's kind of my base case. Again, no certainties, only probabilities. That the reason CPI goes down so rapidly to prompt the Fed to not just pause, but lower in 2023 is not because the Fed did such a fantastic job bringing down the CPI by their interest rate hikes. It's by GFC, cerveza sickness, maybe the dollar creating a global financial crisis, maybe 2.0, just a different version of it, that prompts the Fed to take it down to zero. And because of that black swan event, this is what brings the rate of inflation, CPI, from wherever it is at the time, 7, 8, 9%, down to 2% just overnight. And what's weird is I don't see any of the talking heads even mentioning this as a possibility. So when I read the CPI numbers, basically these are my thoughts. I go straight to the Fed hiking at a more aggressive rate. Okay, what does that mean? It means most likely interest rate differential increasing. That means dollar up. Combine that with yield curve. That would lead me to believe that the potential black swan out there is the dollar going from 110 to 130, 140 as a result of the Fed taking rates, let's just say up to 4% to combat inflation. And they're just thinking, oh, well, strong dollar, pros and cons there. Well, I guess we get our imports cheaper, so that's going to bring down the CPI, but our exports take a little bit of a hit. That's the extent of their analysis. Where, as you guys know, the massive blind spot for them, based on what they're saying, is how the dollar would impact the global economy and dollar-denominated debt, how it would impact the suppliers that are supplying the stuff the United States needs, how that impacts their economies and global trade, and then what are the systemic risks in the credit markets and other places as a result. Maybe what we see is the black swan event leads us to a Plaza Accord 2.0. This would make a lot more sense to me because it sounds crazy, but for the most part, because it isn't on anyone's radar at all. And usually the crisis that you get is the one that nobody's talking about. All right, guys. Enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. See you in the next video.